All right. It is Friday. And as you know, we do our Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
You're well, man. Every day is Saturday, so thank you so much.
Every day is Saturday. I love it. So today is October the 7th, Friday. Today, let's talk about what happened this week with the job numbers. What did you see this week with job numbers?
Yeah, so we got the jobs number this morning. This is definitely the most important number of the week. They came in really hotter than expected. So what happened today? Basically, we got a report about how many jobs were created in the month of September. Heading into this, there was expectation of 250,000. They came in at 288,000, so above expectations. Why is this important? Well, the Fed needs to cause pain. They've always said pain is coming, and you can look at the economy, see lots of sectors struggling, but jobs are still plentiful. We did get the JOLTS report this week, which was important. It showed 1 million jobs openings are now gone. So you can see the job market starting to get closer. We went from roughly 2 openings per every unemployed to now 1.65. So again, it's the Fed is getting what they want, but not, probably not fast enough for their perspective. So in essence, the market is still strong. In essence, we're going to likely get 75 basis points here on November 1st or November 2nd. On top of the jobs number, the big headline, the one that's going to really push the Fed to keep going, was the unemployment rate. The unemployment rate last month ticked up. It went from 3.6 to 3.7. And let's be very clear. The Fed needs to cause the unemployment rate to go up. Unfortunately, at least in the Fed's perspective, it went down. And it didn't go down a little. It went down 2 basis points. So it went down to 3.5%, which is now a record low, right? We have seen 3.5 before, but we're back at that rate, which is it's just like giving the Fed permission to keep raising rates. Well, damn it, the job market's 3.5. We need it to go to 4.5 or 5.5. Let's just keep raising rates. So it is coming. And then the last thing in the jobs number was the wage number. This came in a little bit better than expected. Expectations were for an annualized rate of 5.1. It came in at 5. But again, from the Fed's perspective, normal wage inflation is more like 3%. So again, we are elevated. It's not as bad. It's not nearly as bad as I expected. I actually expected it to be quite higher at 5.3, so I was wrong. But it's still elevated. And really, to net all this out, the Fed's going to look at this number and go, oh, shoot, we've got more work to do, at least in my opinion. So, yeah, I'm guessing the 10-year note's up today and stocks are down, would be my guess.
Very interesting. Now, you did a report, and I want to just, for people that have been watching the show recently that are more in tune because everything's shifted so much over the last several months, you did a whole report about 50 years of interest rates. You talked about from the 1970s, 1980s. You talked about this, and it was almost like what's to come. So with the actual wage inflation, what was the wage inflation like back in the late 70s, early 80s?
So again, it's really interesting. It's the future, whatever it is, the future rhymes with the past or whatever they have to say. A lot of people look at the 70s or they talk about Paul Volcker and interest rates where, he took rates to 18%. But what they fail to realize is the 2 or 3 years that preceded the 1981 interest rate shock, wages were up 8, 9, and 11%. We saw true wage inflation. And the thing that I think scares the Fed the most is wage inflation. It's called the wage inflation spiral. And the reason that's a problem is because once wages kind of take over, it ripples through everything we do, right?
Sure.
When you're Chipotle, your McDonald's, your Marriott hotel, your airline, your truck driver, when everybody needs to make more money to pay their bills, everything goes up. And the wage inflation spiral is nasty. And it's actually what caused Paul Volcker to raise rates and ultimately cause 10% unemployment. So I think wage inflation is coming. I hope it doesn't get that bad, but we need some, right? We need real wage growth, not nominal. Right now we have nominal wage growth. And again, nominal is just headline number. But if you take inflation and subtract it from nominal, it's actually going backwards. So Most Americans are actually going backwards, which is horrible. We need to fix that. So we need positive real wage growth, but we don't need lots of real wage growth, if that makes sense, because that could mean a lot of bigger problems down the line.
Very interesting. Very interesting. So, thank you for that. So let's talk about interest rates. Interest rates for our business, real estate. I know we talk, the national headlines talk a lot about Fed rate. What did you see this last week in interest rates, and just kind of your thoughts on summarizing the week?
Man, interest rates are bananas. If you tuned in the last week, and again, you have a playlist on my channel called TY, check it out. The 10-year note hit 4%. And then by this week, I think it was Tuesday, it might have been Wednesday, went all the way down to 3.6. That is a wild move in 2 trading days. And fast forward to Friday, I think we're back up at 3.87 or something like that. So the 10-year note, which is what I'm quoting here, has been all over the place. We have seen monthly moves in a day, 4 or 5 days in a row. They're not supposed to move this much. There's a lot of wacky stuff going on in the bond market, big rate moves up and down. I think they do trend higher from here. Next week we get the CPI number. I think that's going to be hot. So I think rates are going up from here. But yeah, it's been a wild week. Like if you talk to the mortgage industry, Monday and Tuesday were amazing days, down, right? Because last week we peaked over 7% 30-year money. I wouldn't shock me if we're back to that today, if not probably next week. But dear, yeah, rates. If you like it, lock it. Don't take interest rate risk now. That's for sure.
What Monday and Tuesday, what kind of rates did you hear Monday
So
and Tuesday?
again, I talked to a couple of mortgage guys. He's like, "Wow, we could get 6.7, 6.72." So it went down quite a bit. That's a wild move for 2 days.
30 basis points.
30 basis points. Yeah, it's gone now after Wednesday and Thursday and likely today's move. But yeah, it's not supposed to move that much, and it is. It's wild.
And it moves because of uncertainty, right? Because people are uncertain what's going to happen in the economy. Is that accurate?
Uncertainty and or fear. I mean, it's kind of one and a half does the other, right? Being uncertain maybe is one emotion, but I think fear is a big driving force as well.
Now, I want to just stay on interest rates for one more question for you. So in August, we did see it dip down, and I believe it was somewhere in the mid to upper fives.
We saw it was late July, early August. We did see it dip under 6. Absolutely. I think 5.99 for sure. Yeah, and that was really all based on what people were calling the Fed pivot. But there's basically a talk track that the Fed's going too fast and is going to break the economy. But as we've seen subsequent numbers, the economy is doing just fine, as in the jobs number. We added 288,000 jobs in September, right? If the economy was weakening, we would get a negative number, right? 288 is still down from the month before. It's below the last 5 months, but it's still positive. It's still more than 250,000 jobs were created. The Fed's going to go higher. It's just how it's going to come.
That's how it's going to come. Okay. Well, let's move to our next topic, which is inventory. One of our favorites, right? So low inventory has been a theme of the last 2.5, 3 years, kind of in the COVID economy, pandemic. What did you see this week in inventory?
Yeah, unfortunately, it's going exactly as I called. And if people go back on my channel, you will hear that I called July 20th as the date that we went from phase 1 to phase 2. What happened after July 20th? We had 3 or 4 weeks of FOMO from sellers, just throwing stuff on the market, wish pricing, all of that. Now what we're seeing is we've now clearly entered winter. We've left September. We're now in October. Q4 is going to be terrible. You're seeing cancellations, listing cancellations, not buyer contracts, but listing cancellations. You're now also starting to see expireds, right? They listed in July, it's expired now. So we're seeing inventory, at least in most markets, come down. We are starting to see a bifurcation. I am seeing, at least in my market, the luxury market is starting to stack up because that market is dead, right? A luxury property in Fresno, was okay at 3%. It's not at 7%. But yeah, when you look at total inventory in most markets, inventory is going down. Inventory in my buy box went up a lot, July, August, a little bit, September, but now is down to, almost nothing again. So it's interesting to watch. But yeah, I think inventory falls in October, falls in November, falls in January. We'll see what happens in the housing market in March. This is all going to just be housing depression until March 15th. when we see if we're coming out of this or not. And I have no idea at the moment, but inventory is down in most areas.
Yeah, and I would completely agree with you. I look at hot sheets every day. I look at the MLS, and every day I'm seeing cancellations, more withdrawn canceleds than expireds. But
Yeah.
absolutely, the end of the month, we saw big numbers in expired listings, and or every day, every week, a lot of cancellations. Let me ask you, so just to really be clear on your thought, you believe this trend of low inventory continues through the beginning of the year into potentially February, March, and then we'll see what the spring market looks like after that. Is that pretty accurate?
Yeah, it's exactly accurate. And again, it's for me, March 15th is easy because that's usually the start of the spring selling season. But more importantly, that gives us 6 months to figure out where we are. Are we in a nasty recession? Are we in World War III? Where are gas prices? Is the unemployment above or below 5%? You know, and again, after March 15th, you may hear me say we're going into a housing crash price. You may hear me say, oh, the Fed just lowered rates. We're going to build out of this slowly. I have no idea. But I know between now and then, I'm still saying that prices are pretty sticky at the national level. But we'll see. I do feel great about my housing crash call on transactions. I think we're going to get to 50% drop sometime over the next 6 months, but we'll see about price. I won't really have any thoughts on price until March.
Very interesting. Well, I feel like you've been so spot on, especially the last 90, the last 180 days, the last 6 months, 9 months. We've been talking about this for the last year and a half. Let's talk about Fed pivot. What is a Fed pivot? What are your thoughts? What did you see this week?
Yeah, the Fed pivot is a very important topic, and there are 3 Fed pivots that we have to talk about. And when you hear somebody talking about, you need to understand which of these 3 they're talking about. Fed pivot number 1, example, Bank of Australia. The market expected 50 basis points. The Central Bank of Australia gave them 25. So they under-delivered. That is pivot number 1. In the US market, the market now expects, I think, at 92% likelihood of 75 on November 2nd. If the Fed gives us only 50, that is a pivot, in my opinion. If the Fed delivers less than the market expects, pivot number 1. Pivot number 2 is a pause. I personally believe, as I'm calling it on October 7th, we get 75, we get 50, then we get 25, then we get a pause. So for me, the pause is February, March. Others are saying, including Bostic, who's a Fed president, he wants to pause after December. All right, Fed pivot number 2. And then there's the folks like Elon Musk or Cathie Wood who are saying the Fed doesn't need to deliver less, doesn't need to pause, but needs to cut. I don't see it, but everybody deserves their right, their opinion. So those are, when you hear Fed pivot, you must step back and go, are you under delivering? Are you pausing, or are you cutting? So in my opinion, they don't under deliver. They do 75, 50, 25, which I think the market will expect. Do they pause early, meaning pause after December? I think they wait one more meeting. And I don't see a cut, Ty, until 2024. Let me just talk about a cut. For people that are wishing for a cut, I want you to realize what you are asking for. The only way the Fed cuts today, because they would be risking their reputation, is if we have a market accident. And I am not talking about a little market accident. I'm talking about a big, nasty implosion threatening to take down the entire financial system. Be careful what you wish for. I hope and pray and wish they don't cut until 2024. I hope they are on pause all of next year. I want one rate increase in their first meeting, whenever that is, January or February. And then I want them to stay flat, because that means we can start rebuilding from a better spot. To get a cut early next year means something big broke, and that frightens me.
Interesting. Very interesting. So when Elon Musk and when Elon Musk is requesting this, is it in the self-interest of He just wants to sell more Teslas and more solar systems, or what is the position there?
I think a lot of people talk their own book. There are a lot of billionaires on TV. Elon Musk is just one of many, whining and crying because they're in a business that's very loan heavy, right? There was a billionaire yesterday who was whining, and I look him up because I don't know. I don't know these people. I'm like, why is he on my TV? So I look him up. Shockingly, he's a real estate guy. Yeah, I bet you're whining because maybe you have some adjustable rate mortgages or some bridge debt, and suddenly you're going to have to write a big check. There's a lot of people talking their own book. Teslas are expensive. Lots of people get loans. A Tesla at 8 or 9% interest on an auto loan is very different than 3. So yeah, I'm going to assume that. And Kathy Wood, she's buying these companies that don't make any money, that live on debt, that maybe are something in the future, but a lot of them go broke if they got to borrow at 8 or 9. So yeah, I think there's a lot of billionaires, stock people, lending people talking their own book. So that's, again, I could be wrong, but that's my opinion.
Yep. Okay. Very good. Well, we're going to keep our eye on that. I want to ask you, this is a side note. So with oil, just a conversation, kind of a household conversation, talking with a couple of my buddies, talking with a couple of people, vendors, contractors, guys that work for us. Everybody was complaining this week about oil, right? You and I are probably locked in our office all day, making phone calls, doing deals, and, on Zoom meetings. What happened with oil this last week? And this is a curveball. We didn't talk about this pre-roll. So
no, it's awesome. Yeah. OPEC is basically a cartel. We're raised in schools, or certainly an economist, to learn that cartels are bad. But basically, OPEC's a cartel, and they get to set. Basically, they set the price of oil, and OPEC is not happy with oil below 90. It was actually below 80 earlier this month or earlier last month. And basically, they came out and said, we're going to lower oil production by 2 million barrels, which is a problem because, again, the oil market is very tight. So oil is already up, I think, $10. Okay. In fairness, it's not quite that bad, right? 2 million is a scary number. It turns out to be more like 800,000 or 900,000 because they weren't producing to their original target. So they were already underproducing 1 million barrels. So really a 2 million barrel is, the other million was never there. But you're still talking about, oil production being down 800,000 barrels a day. And this is going to hurt. We have the midterm elections, November 2nd, I think. And gas prices could be going up in the face, and that could hurt the incumbents. And I would think that OPEC did that on purpose, frankly. I think they were not happy with our current president and what he's done, because he came out and was very anti-Saudi Arabia, and then he went over to Saudi Arabia hat in hand and said, help us. I think they see an opportunity to inflict some political pain, and they're doing it. So, and that's in the face of Europe. I mean, Europe's in even more trouble. So I think gas prices go up, which gas prices are headline inflation. So it maybe peak inflation is not over, which is frightening to say.
Very interesting. Very interesting times. And then, so for our last topic, pre-announcements, and then AMD. Who is AMD? And explain what pre-announcements are.
So AMD is a chip maker, right? They compete with Intel most recently, or is their big competitor. And what is a pre-announcement? So everybody who trades stocks know there's this thing called earnings seasons, right? They have these earning dates. They come in and they parade their financial reports. A pre-announcement is a company coming out going, whoops, we missed, right? We told you we were going to do X. We're going to do X minus. So a pre-announcement is not a good thing most of the time. And AMD came out with the nastiest pre-announcement I have seen in a long time. They lowered their margin 4%, which means they're going to earn less money. But more importantly, their revenue was down $1 billion, $1.1 billion. So AMD makes chips. So I have to sit here and ask myself, well, they're selling a lot less chips. Does that hurt PCs? Does that hurt phones? Does that hurt this? Does that hurt that? So I think I think AMD is not the last pre-announcement. But again, pre-announcements are generally negative and hurt stocks. So AMD came out yesterday and said, man, we missed it. We thought the quarter was bad. It was really, really bad. So we'll see what comes. It's going to be an interesting earnings season.
Very interesting. Well, folks, a lot of uncertain time. thank you, Michael, for all the research, all the work that you do. I know personally in my circles, the buzz of what you're talking about. And more importantly, people are saying, you know what, where's the opportunity? And that's what, that's our whole intent, is not to scare, but to really just be aware. Okay, the economy's shifting, real estate markets are shifting, interest rates, money markets are all changing. Where do we find opportunity in all of this? So any last words on this show today about opportunities in this shifting market?
Yeah, again, what I want to tell people is opportunity lives behind fear. Everybody listening to this has always thought, hey, the next time there's a recession, I'm going to make my moves. Realize that folks like Ty and I, we're going to make a lot of moves. We're going to put less money to work and get more, more deals. But a lot of people are already getting scared. And if you get scared and do nothing, you're going to miss it. I don't ask you to write deals. I ask you to do the work. That's all I want. Do the work, understand average, and do great deals. The best way to beat fear is to do the work. That's all I want you to do. I can't promise a deal. I can't promise a return on your time, but damn it, if you build that muscle of keeping the do the work and networking, you'd be shocked at what you can accomplish in the next couple of years.
I love it, folks. You heard it here. Do the work. So, Michael, as always, thank you. I want to encourage everybody there, everybody out there watching right now, or if you're watching or listening to this, do yourself a favor, follow Michael, one rental at a time, social media, the best content, I believe, on YouTube at one rental at a time. Also, too, I've got to say, I've noticed something with you, Michael, working with you now for more than a year, your commitment to innovate, your commitment to over deliver to the community. Michael's working on some things. We've been working on some event for November. We've talked about it before. Now, potentially it's a couple of events that potentially may happen. So stay tuned. There's more to come. Michael, thank you for all that you do. Have a great weekend, my friend.
Got it. Take care.